What's up, guys? This is Carter Thomas, Coinmaster TV. Now make sure you hit the bell, the notification bell. Apparently YouTube's getting cute with their algorithm, and if you hit the bell, you get notified for all the new videos. Yeah. So today we're talking we're going to briefly talk about Bitcoin, but we're going to talk mostly about the bigger picture stuff. I think that obviously is what people like more of. So we'll just look at this briefly as a place to get our feet wet, talk about some potentially bullish news, ETFs. We're talking about what Coinbase is doing, which is kind of neutral. And then we're going to talk about our good friend George Soros. And I don't know if I'd label it bullish or bearish. I just think it's important for you guys to know what's going on, because I think a lot of people may not know the full extent of what professional trading means. High frequency trading, aggressive trading, to put it very, very lightly. So we're going to talk about that, a little bit about what you can do, but we'll get into it. So, good friend Bitcoin. As we looked at yesterday, we are just, this is it. Like the next week and a half, this is going to be this is going to tell the tale for the rest of 2018, in my opinion. And there's a lot of the two narratives. One are that it's for the U.S. at least, taxes are going to go and people are going to get their returns, and we're going to have this huge tax infusion, and there's a lot of consensus is happening next month. There's a lot that is going to keep this curve in the right direction. We're going to bounce off this trend line and off to the races. That's one narrative. That is definitely what I'm hoping for. I'm sure it's what most of you are hoping for as well. The other narrative being that there's just not enough bull support, that this thing is still way too overheated, and that it needs to fully collapse, not unlike the internet bubble of 99, 2000, where you can see it here. And I pulled this up. We'll talk about this later, but I just want to show as a point of reference. Not saying that's what necessarily will happen, but those are the two narratives. And I think we will figure out what is going to go down in the next 2 weeks. The reason why I think this is important is for most people, and hopefully not very many Coinmaster viewers, because you guys are smart, epic, I love it. Most people will wait until something happens and then they'll make a plan. But know that something big is coming here. I don't know if it's going to be down or up. No one does. But you can definitely make a plan one way or another. If it is going to completely stress you out beyond all words, if this thing did tank down to 3,000 and didn't come back for a while, you need to make an adjustment. Similarly, if this thing takes off and you're not prepared to get some of that upside, you need to prepare for that as well. But just have a plan. But we're not going to get hung up on that. We've talked about this to death, so we're going to leave it at that. Happy Friday, rock and roll. The other big news is down here. You can see this indicator if anyone ever wants to put this on the trading view charts. This is called Bitfinex BTC Margin Traders, and it gives you two lines as it relates to what the margin levels are on Bitfinex, how much margin trading. And you can see this as an actual ticker, which I pulled up here, called BTC USD Shorts. It's on Bitfinex. It's a ticker you can pull up right there. And as you can see, at least as far as the back to when TradingView started pulling this data, we are now at the all-time highest level of short activity ever recorded on Bitfinex. So if you don't know what that means that there is more people than ever before, or more volume, I should say, more money being bet against this price than in history. And the traditional theory, or traditional logic, I should say, is that there's a mass amount of downside pressure on the shorts. But as many of people know, especially if you're a trader and you've been in any other sort of equity market before, often whenever you see a huge buildup in short pressure, that actually has the reverse effect, where you get some whales that come in and just absolutely decimate the short volume. It's called a short squeeze, and it just liquidates the books to clear out the market, to not only like, not punish, that's the wrong word, but it just frees up the market. It releases the pressure from the market, and hopefully releases the pressure on this downside volume. Now that it always happens differently than people think, because if anytime there's a pattern in a market, it's not going to be a pattern for very long. So keep an eye on this. This is a really big deal that there's this much short action, especially on a Friday. I think that there is something to be said. Many people trade on Fridays and then they go home at 5 o'clock, whether they're in Asia, Europe, United States, wherever. But if there's institutional money trying to make something big happen going into the weekend, good or bad, you're seeing it right now on the short. So that all culminates. Just have a plan. It's the best you can do right now. Okay? Now let's talk about some bullish news, potentially bullish news, hopefully bullish news. CBOE, which if you guys remember, they were the first to release a futures product. It's actually an option. It's more of an options clearinghouse, but they do have futures products. They released Bitcoin futures, but it's smaller than the CME. They have been lobbying the SEC to get an ETF for a while now, and it looks like the SEC may be putting it back on the table, as they say, quoted from this CoinDesk article. So by no means is it a sure thing. It does not mean ETFs are coming. It just means that there is a lot more possibility than there was a couple months ago. And there's a lot of things that go into that, many of which goes into regulation, many of which goes into volatility, custodial, the whole thing. And the other, but the thing to keep in mind, it doesn't necessarily, especially with the CBOE, doesn't mean that it's going to be settled with Bitcoin. They'll probably be settled with cash settlements or at least CBOE futures. So it doesn't mean the spot price of Bitcoin necessarily gets impacted if more people buy the ETF. It just gets more people interested, same way futures did. So it's just, more eyeballs is a good thing. I think the 21 million fixed supply of Bitcoin is becoming a bigger and bigger deal as it relates to the overall market news. And right, guys, as the market picks up, like it's gonna pick. I don't know how long it's gonna take. I don't know how it's gonna happen, but at some point it's gonna go back up. And when it does, that's when we could start talking. We can talk about the tech a lot more, talk about new products and things like that. But the thing is, until all of this macro and all this pricing action is fixed, it's very difficult for a lot of this tech to thrive because the financial side of this is going to just trump everything because that's where all the regulation comes in, right? That's what brought so many retail investors in. So we're going to keep an eye on this. I would say overall it's a good sign. What you really want, like the ideal situation, is when you get an ETF that's actually buying some amount of Bitcoin as it relates to the price. So the more people buy the ETF, the more Bitcoin is actually being purchased to collateralize that ETF, even if it's just a small amount. You see that sometimes with gold or with silver in ETF, or at least you have in the past, and that would be ideal. So we're going to keep an eye on this. Good sign. I think the bigger piece of this, you're seeing so much stuff happening without the SEC or the CFTC coming out and saying, like, here are the new laws, here are the regulations, here's what's happening. You're seeing a lot of these things happening that are clearly happening behind closed doors for weeks, and we're finally seeing the light of day. And I think that's true with pretty much everything in crypto right now, is that they're all talking to regulators. They have been for a while, and there must be some semblance of crystallization or clarity being come to that the public doesn't know about yet for obvious reasons, but that's allowing for certain things to get some headway, some steam. Not unlike what happened with Coinbase yesterday. Obviously, CNBC did their typical Tron level hype fest where they get Coinbase announcements pumping on CNBC. They released a couple pieces of news. Mostly it's just about this thing called Coinbase Ventures, which is an incubator. If you don't know what an incubator is, you should move to San Francisco. There's one on every corner. No, I'm just kidding. It's like a group or a fund that brings in startups, and it will give them money, it'll give them mentorship, it'll give them access to teams, it'll give them experience, in hopes that that startup goes on to build something amazing, and then the incubator will keep a piece of it. So Y Combinator is a very famous one. Founders Fund, which is Peter Thiel's very famous fund. There's a lot of these that have become very famous. So Coinbase is going to do this for crypto related, or not even crypto related, but just the ecosystem related startups. They're going to give maybe preference, but I mean definitely preference. But people that used to work at Coinbase are going to be able to get involved. But really, I'm sure they'll open it up to anybody who wants to apply to get in, things like that. So this is a typical venture capital move, right? And it's important to remember that Coinbase is a VC company. At the end of the day, that's what they are. They're funded. They report. They have quarterly board meetings. They report to people. They are not this is not like they're just, doing it on their own. And so you're going to see more and more of this look more and more corporate. It's just what they do. And unfortunately, or fortunately, however you want to look at it, that is just how the markets grow. This is what people need to see. They need to see nice packaging. They need to see things that are easy to understand. Venture funds, index funds, stuff like that. Now, one thing that came out of this Coinbase meeting yesterday that was really interesting is they talked about when they're going to add new coins, because that's all anyone cares about anyway, obviously. And they said they will, especially through the custodial side, which will eventually make its way to the exchange, meaning they'll add stuff to the index fund, but not onto Coinbase and GDAX. It'll go in that order. But they said something very interesting, kind of in passing. They said the coins that are listed currently on Coinbase and GDAX are the only coins that they feel comfortable with not being a threat from the SEC, CFTC, whatever. And I thought that was super kind of, maybe I'm sure they're playing super defense on that. But we've talked about that with liquidity, is that when you're looking at your portfolio, I mean, Abra just came out yesterday. I think they're up to 20 coins. They're doing fiat pairings. So obviously they have some level of legal precedent or at least, legal authority to do that. But maybe they're rolling the dice. I mean, they probably may have less to lose than Coinbase does at this point. But we're still not out of the woods yet with the SEC coming out. Like they're nailing Centra and like the super scams and BitConnect and all that stuff. But we don't know what the true implications will be for anything else, for other ICOs, for US-based companies, for foreign companies and stuff like that. So really interesting to watch this stuff come out. I think that overall this is a very good thing for the space, but it's not going to be short-term. Like short-term, it's not going to be, oh, wait, alt season, yeah, let's pump it. It's not like that. It's more like this is legitimate so that in 5-10 years, this will still be around, which is actually a pretty big deal. All right, second last topic, I guess. This is all kind of intertwined, I get. George Soros prepared to trade cryptocurrencies. So this came out. Now, first of all, this is obviously like they've been trading this for a month. Like, there's no way they just said, "Hey, send out the press release on that Friday, because I think by Monday we'll probably be ready to fire up GDAX." Like, it's not. No, they've been doing this for a while. They've been very prepared. This is a pure press release, PR campaign. Okay, because they know how this stuff goes down. So there's a few things that I've had a reaction to. And, before I forget, my daily reminder that none of this is professional advice whatsoever. This is just complete entertainment. Don't listen to anything I say, ever. Nothing. Zero. And George Soros came out and he's like, Bitcoin's a bubble. He never actually came out and said that it's like as negative as someone like a Jamie Dimon did. But he did come out and said this is a pretty clear bubble. But now he's coming in and his fund is going to trade it. And that's a critical differentiate. It's not George Soros. Okay, it's not this 90-year-old dude who looks like he's about to fall over and, have a not do well. It's not him trading. Okay, he's got a massive arsenal. He's probably got a crew of people in Stamford, Connecticut, sitting at trading desks with T1 connections, dropping the hammer with trading tools and Bloomberg terminals like every other hedge fund has in Connecticut and New York City. So it's not him, okay? He's the face. He does some of the deals. He's got the money, but he's not actually doing anything. It's just his fund. So that's the first thing to keep in mind. But George Soros, if you don't know much about him, I would encourage you to go read up on him, is a ruthless and very, very successful hedge fund manager. So during the 70s, his fund, I think they did 4,800% returns over the course of a 10 or 12-year period. His partner, Jim Rogers, who you may know, some of you may know him. He's a little bit more, he's an American, and Soros, I believe, is from Austria. And they have very, very different styles, but they crushed it. And their big move is obviously shorting the Bank of England, but they've got dozens of these huge bets, contrarian bets that they would put against huge markets, commodities, a lot of currency markets, and things like that. And their goal is to really just bet against the crowd in a big way and try to flip those kind of macro movements based on huge, not even maybe black swan events. And so he has he's ruthless in the sense that his reputation precedes him in the way that he kind of, when he wins, everybody else loses, historically speaking. Okay, I mean, this is not all black and white. There's obviously cases where this does and doesn't happen. I know that. But that's what he's kind of known for. And that's typically what his trading style has been. And I would imagine his fund has a similar trading style. Meaning they may look at Bitcoin and they may look at crypto. And they're like, how do we bet huge on this? We start by trading, and then how do we bet huge on this so that if he wins, everybody else loses, at least in the short term. A total guess would be like, well, how do we get this down to $500 and then take it to 200,000? That would pretty much decimate 95% of the people out there and make their fund massively rich. That's just one example, but that's a kind of thinking that they're known for. Similarly, on a more macro standpoint, if you ever want to learn about what he's up to, go check out the George Soros lecture series. I'll link to this YouTube channel because the book, The Alchemy of Finance, is actually really good, but it's unbelievably dense. And I don't think if you like econ and finance, you can go check it out. It's in the Core Mastery store. I'll show you in a second. But this YouTube, it's like a 5-part video series. They may have condensed it into one. It gives you the idea of what reflexivity is, which basically means that markets are self-fulfilling prophecies, which is why things go parabolic up and down, right? Panic selling, mania buying type of thing. So there's a lot that's going into all this. I think the takeaway I have from this is that it's becoming very real to me, and I think to other people in the space, that a narrative in our world, in crypto, in the retail investing world of crypto, is that big money is going to come in, institutional investors are going to come in, and that is going to buoy the price up and move it forward. And I think what people are starting to realize is that that's not how it works. Professionals, these guys are like sharks among sharks. They do not come in and lose. And that's not even true. I'm not just talking about Soros or anybody. I'm talking about anybody who's a professional trader, futures trader, commodities trader, anybody. And so as these guys come in, they're going to come in with all guns blazing. And one tweet I put out this morning says swing trading is only one way to make money in a market, meaning buy low, sell high, or short a stock or short a coin, right? Which is really what most people do in our positions. It goes up long term, it goes up short term, whatever. Bitcoin price does not need to go up or down a lot for money to be made. High frequency trading or pro traders can make billions of dollars on a price bounce up and down of $100. And the pro mindset is this, quote, how do I make money from the market and not from the assets. This is the key, okay? And this took me a long time to realize. It took me years and years to figure out that this is how professionals make money in the market. All the stories and all the shows and all the books are all about the guys who make money on the assets, but the real money is made in the market, is made off of the markets. And so you look at something like the Bitcoin market or even the cryptocurrency market as a whole, and guys like George Soros or their funds or any of these funds, these trading funds will come in and they look at what's going on and how can they make the most amount of money. For example, let's zoom in to the 1 hour, probably even shorter term than that. Let's look at the 30-minute chart. I'm going to delete this on Bitcoin. And you see it like how much this bounces around. Right? So you look at this is just on Bitfinex. You can same thing on GDAX. You can look at something like the BitMEX chart. Any of these charts, especially with margin trading, have all these wicks on them. Like these are just going up and down, up and down, up and down. And if you have really sophisticated software, if you have really high frequency trading software that can front run all these, that can move a lot of money around, that can wash trade both sides of the trades, you can make enormous sums of money. Where like someone might be like, oh, I'm just going to hold my Bitcoin at, let's call it 6,700. And a week later, it's still at 6,700. Meanwhile, these high frequency traders just made $200 million off of scalping all this volume, off of the 2 million other people that are buying crypto or whatever. So over time, all that money gets pulled out of the holding price, the spot price, and gets moved into the pockets of other people. This is what high frequency trading is all about. That's why it's the biggest ripoff in the history of ripoffs. Like beyond words, the fleecing of the world, of the average person economy is high frequency trading, in my opinion. People should be in jail for this for like decades. But that's how professional traders look at this. And that is how these guys are going to look at this. They do not come in and say, all right, let's get this down, let's buy it up, and then, let's get our 20 or 30% returns. Okay, that's maybe attractive, but this market is not nearly big enough for that sort of investment strategy. What they will say is, look how volatile this is. Look at the people who own this stuff. Look at the potential for movement. How can we just extract as much volume and volatility from this price and just scalp it all away because our software is 40 times faster than any software anyone else has access to? That's what happens. This is one example of what happens. If you want to learn more about this, how this happens, go to coinmastery.com/store and go read Flash Boys by Michael Lewis. Now, I'm the first to say I love Michael Lewis's books, but they're stories. He's a very good story writer, and I've talked to people who I've actually talked to people who built these flash trading, like they build the servers, the T1 lines, they ran the cable, and they say it's like 80% accurate. There's a lot of embellishment. There's no false information. It's just, Michael Lewis does a really good job with the characters and development, as opposed to just like pure facts. But you will learn an enormous amount about how this works and how automated trading, algorithmic trading is like really just running the show. Now, luckily is kind of a loose term here. The SEC is starting to crack down on this to a certain extent on Wall Street. It's still very rampant. In fact, I remember reading, I don't have a source for this, but I think it was in 2016, Goldman Sachs, 70% of their trading profits came from high frequency trading. Think about that. This is like a multi-billion dollar company, and 70% of their profits are coming from high frequency trading. All they're doing is front running trades and ripping people off, and they're legally putting that into their bank accounts. So anyway, I'm not going to talk more about this other than realize this. These guys play the game differently than the way you and I play it. They do not buy low, sell high. That is like one of 30 strategies. They come in and they pull money out of the market. That's what they do. That's as effectively and as profitably as they possibly can. And the more you are aware of that, the more you can do something about it. Now, the obvious next question is, okay, well, how do I combat that? How do I play defense on that, or how do I make sure that they don't do it? The unfortunate truth is that there's not a whole lot you can do. Like, yeah, you can hold it, but part of their whole strategy is maybe just not move the price for a year. Is holding still the best defense? I don't know. I'm telling you, the best defense is to be offensive, to go get more people to buy crypto on an exchange, buy Bitcoin on an exchange, because the only way a force, if I zoom this out, the only way the force can overpower futures traders, high frequency traders, all that, is if you get a demand curve that is so strong that it is impossible to push down, especially with a fixed supply. That is why I talk about this stuff over and over and over. Like when you talk about revolution and like bringing it back to the people and all that, that's the only defense that is proven and will work. And some people don't like to do that. They don't want to think about that. It's kind of, but man, just get 10 people, get 5 people to go buy $50 of the Bitcoin. Tell them to go get 50 people. Start a YouTube channel. Go get on Twitter. And instead of posting GIFs, actually help people and get them to go buy $50 of the Bitcoin. Anything. But otherwise, same stuff is going to happen on Wall Street. Is that you're going to watch the market cap go up to $4 or $5 trillion. You're going to watch Coinbase. You're going to watch Soros' fund. You're going to watch JP Morgan. You're going to watch them all make bank off of the crypto world. And you're going to watch Bitcoin's price go up a couple $100 a week, maybe $50 a week, down $50 a week. And yet the whole thing is just exploding. And you're going to be sitting there being like, what is going on? Like, what am I missing? And that is why you look and you remember history repeats itself. A lot of people made billions and billions and billions of dollars between 2001 and 2006. But the average investor, they didn't crush it. They like doubled their money if they bought an index fund, if they bought the exact bottom, right? Good for them. But most of them who are just holding from 96, it took them almost 8 years to double their money. So all of this was just kind of petering around. Meanwhile, there are people that are making billions and billions of dollars. The same thing could easily happen in crypto, but we have there's a big difference. And that's at 21 million, at least with Bitcoin, and with some of the other ones, which are like use case tokens where you can go out and actually use the thing, where we can have more control over this sort of thing than we ever could before with stocks or bonds or equities or anything. And that is such an important piece of the puzzle that seems like a small deal, but it's not when enough people do it. So I can't stress that enough, because these guys are coming and they are terminators. I can't, whatever. So anyway, we're gonna keep an eye on this. The good news is there's a lot we can do. The reality is that it's David and Goliath situation, but don't let that stop this, right? I know the price is going down, and like obviously I'm more of a trader mentality than I used to be, like just diehard holding, whatever, that's my call. But I still believe in this, and I still believe that there's a huge possibility in this, and I know most of you do too. And don't forget that. Keep an eye on that price, because this can take down these forces that are trying to liquidate this thing. Like you can move the demand curve in mass. It is absolutely possible. And it's never been possible like this before. So with that, I'm going to go and enjoy the beautiful fog of San Francisco. TGIF, rock and roll. Hope you all have a great weekend. Stay rad, and I will catch you later. All right, peace out.